The U.S. markets are currently closed. Nuburu Inc. (BURU) closed the last trading session on Friday, October 10, 2025, at 47.5 cents, marking a gain of 2.88% for the day. Now, you might see this sub-dollar price and immediately dismiss it as a forgotten penny stock, but hold that thought. The most critical yet underreported aspect of the recent price action is that this company, which started in blue laser technology, is undergoing a profound corporate transformation, rapidly pivoting to become a defense technology and security solutions provider through a series of tactical acquisitions. This isn't just a slight business shift, it's a complete change of identity and market focus, and the stock's extreme volatility, witnessing a 283% gain over the prior 2 weeks as of October 10th, is a direct reflection of a market trying to price a completely different company than the one it knew 6 months ago. The common expectation for a stock trading under $1 is that it's simply struggling to survive, often facing delisting or dilution worries. While Nuburu was in fact dealing with NYSE American compliance issues earlier this year, the reality is that the new management, led by its executive chairman and co-CEO, Alessandro Zamboni, has been executing a high-stakes strategy to fundamentally rebuild the business around defense and security assets. The noise from the compliance plans and frequent public offerings to raise capital, like the recent $12 million offering to accelerate strategic growth, is what most retail traders focus on, but the deeper, more impactful news is the aggressive M&A strategy that has been put into action. The short-term price movements are fascinating, reflecting an underlying struggle between selling pressure from previous shareholders and massive buying volume driven by news flow. On that last trading day, the volume was extraordinarily high, indicating a strong institutional or large-scale retail interest trying to take positions in the new Nuburu. The stock had a day low of 46.7 cents and a day high of 55.9 cents, which is a nearly 20% swing in a single session. That's highly speculative trading, not value investing. It tells you that every press release regarding their strategic defense transformation, such as the binding agreement announced on October 7, 2025, to acquire Orbit SRL, an Italian software firm specializing in operational resilience, is being met with a powerful, albeit volatile, price reaction. For an online investment strategy, especially one focused on high-growth defense tech, this volatility presents both massive risk and potential alpha. If you're using a self-investing platform like Robinhood or SoFi Invest, you're seeing those daily swings front and center. But the crucial missing piece of the puzzle is the nature of the assets they are acquiring. This isn't just about selling high-powered blue lasers anymore. It's about integrating software as a service or SaaS for operational resilience with electronic warfare capabilities from a previous target, Techne, and their existing laser-based hardware. This pivot to an integrated hardware and defense-grade SaaS solution is what differentiates the current reality from the old expectation of a pure-play industrial laser manufacturer. Looking closer at the Orbit acquisition, which caused the stock to soar 26.8% in pre-market trading on the day of the announcement, the market is essentially valuing the future revenue streams from a high-margin recurring revenue software business. Orbit projects a significant revenue acceleration, targeting over $19 million by 2028. This is a crucial data point because Nuburu's historical revenue has been negligible, and its financial position has been challenging, evidenced by the non-meaningful PE ratio and negative earnings per share of -$1.25. The shift to a SaaS component addresses the historical challenge of operating a capital-intensive hardware business. By focusing on defense and security, Nuburu is targeting an operational resilience market across the US, EU, and NATO that's estimated at nearly $3.6 billion in 2025 and growing annually at over 10%. This is a huge market, and the new management team is banking on the synergies between their high-powered blue laser technology, which can be used for high-speed, high-quality metal machining and additive manufacturing for defense applications, and the acquired defense tech companies to gain a meaningful share. When you're managing your intelligent portfolio or using a Fidelity platform for online investing, you rarely see this kind of dramatic top-down transformation, which is why fundamental analysis here is more about the strategic narrative than past financials. The general belief among the less informed investors is that this is merely a desperate attempt by a struggling company to stay afloat, using reverse mergers or quick acquisitions to inject capital and dodge delisting. The initial perception is one of high-risk corporate restructuring. However, the contrarian take, the deeper reality, is that this is a controlled, albeit aggressive restructuring backed by capital raises and specific government-related strategic guidance, such as the Italian government's guidance on the Techne acquisition. The company is systematically building a defense and security hub through multiple planned acquisitions, essentially trying to manufacture growth in a high-demand sector with strong government and international support. The fact that the CEO is the owner of the acquired company, Orbit, which necessitates a review by external financial advisors and approval by Nuburu's independent directors, is a common structure in corporate restructurings of this magnitude and highlights the complex, interconnected nature of this new defense focus. This level of corporate maneuvering is highly relevant to sophisticated interactive brokers users or those using a more analytical Fidelity trading platform. The sheer volume of corporate updates and strategic announcements since the beginning of 2025, covering everything from eliminating long-term indebtedness to new joint ventures, underscores that this transformation is the one and only factor driving the stock price, completely eclipsing the legacy blue laser business. The challenge for Nuburu, and the main tension point between expectation and reality, lies in the execution. Can a company built on industrial lasers successfully integrate and scale sophisticated defense-grade software solutions while simultaneously managing capital structure issues? The historical business of Nuburu, founded in 2015, centered on its high-powered blue laser technology. The physics behind blue lasers are genuinely compelling for certain applications, especially welding and additive manufacturing of highly reflective metals like copper, gold, and aluminum, where traditional infrared lasers struggle. Their AO laser and high-brightness Misaki laser were designed to create faster, higher-quality welds and parts. This original core competency, however, appears to have faced significant commercialization headwinds, leading to persistent losses and a need for a dramatic pivot. Past financial reports show a company with minimal revenue and substantial operating losses, with a net loss consistently in the millions of dollars per quarter. This is the reality of the original business model, a great technology with a difficult path to profitability in the industrial market. The expectation now is that the defense pivot changes this entirely. Institutional activity, while low in overall percentage, is showing interesting movement. The institutional ownership percentage sits at around 0.56%, but recent 13F filings show funds like GEED Capital Management significantly increasing their positions in the last reported quarter, and new positions being initiated by names like IHT Wealth Management. This suggests that while large institutions are mostly sitting on the sidelines, some smaller, more active institutions and funds are starting to take notice and bet on the new defense narrative. This is typical for deeply speculative restructuring plays. Either you're selling out of the old industrial laser company or you're buying into the new defense tech company. The diverging opinions are reflected in the conflicting technical signals, where a 3-month MACD shows a buy signal, yet a separate AI score from a financial data provider places the stock in the strong sell category due to its probability of underperforming the S&P 500. This is the market fighting itself over what Nuburu actually is. For those of you managing a self-directed individual brokerage account or using a Schwab Intelligent Portfolios approach, you're constantly evaluating where true growth lies. Is it in established giants like Apple stock or Nvidia stock, or highly speculative turnarounds like BURU? The future outlook for Nuburu is entirely dependent on its ability to complete these acquisitions and successfully integrate them into a functioning defense and security hub. The immediate catalysts are the subsequent milestones in the Techne acquisition and the final equity-based settlement for Orbit by the end of 2026. The new strategy focuses on leveraging defense contracts, like the rumored €50 million military deployment, to establish a stable recurring revenue base. If Orbit's projected revenue acceleration from $3.22 million in 2026 to nearly $20 million by 2028, the current valuation of Nuburu will look dramatically undervalued, even factoring in the recent price run-up. The risks, however, are substantial and cannot be ignored. The potential for further dilution remains a constant threat, as the company needs capital to complete the two-phase acquisitions and sustain operations until the acquired assets become cash flow positive. There is also the significant execution risk of integrating disparate defense and software technologies across international boundaries. Regulatory approval, particularly given the sensitive nature of defense technology and Italian government oversight for the Techne deal, is another hurdle. The company also needs to maintain its listing compliance with the NYSE American, which, while accepting their compliance plan in July 2025, remains a pressure point. The company's focus on the defense market, while promising, exposes it to the cyclical and politically sensitive nature of government contracting. This isn't a simple business, and the turnaround is complex, multifaceted, and highly dependent on the skill of the new management to navigate complex acquisitions and military procurement processes. Investors relying on investment help from a service like Fidelity Wealth Management, or even looking for basic features on the Fidelity mobile app, should be aware that this stock requires deep, active management, not passive holding. In the near term, we're likely to see continued volatility driven by news volume and speculative trading. The fact that the stock has surged over 280% in 2 weeks suggests a short-term momentum trade is in effect, which can reverse just as quickly as it started. Maintaining support levels, like the 47.5-cent level established by accumulated volume, will be crucial in the coming trading days. If the market continues to see positive news flow regarding the acquisitions, particularly financial details that confirm the projected revenue ramp-up for Orbit, the price could easily test the 52-week high of $1.60. Conversely, any misstep